As you can see, we've had about another 130 people join us in the last hour, which is fantastic. Thank you very much. This is Simon Campbell. I'm hosting this round-the-clock trader event, the final monthly event that we have for 2016. Super to have you here. We are running just a couple of minutes behind schedule, so we're going to go right ahead and bring in our next speaker, Rob Colville, the lazy trader. And we're going to look at his set and forget trading strategy. So I'll take the microphone off and say good morning, Rob. I think you should be able to hear me now.
Good morning, Simon. Absolutely, loud and clear. How are you doing?
We're very well, thank you. Very well. Nice, busy final event to end the year on a high, which is great. Sorry to keep you waiting. We're just a couple of minutes behind schedule, so we're just going to keep the momentum going, and we'll go right across to you to share the screens and see if we can get you started.
No problem.
So
Let me just
you should have.
share the screen.
Those of you that haven't heard Rob before, he's spoken several times on this event. You are known as the lazy trader. You like to enjoy a life at the same time as trading, which is why you've developed these strategies where you can cut yourself free from sitting at the screen all day.
Absolutely. I mean, very much like Zahir, and it was great to hear his presentation. He did a great job. I mean, I chose trading really as a vehicle to make money. I don't really have an intellectual fascination with trading at all. I just really came across it about 9 years ago and made every single mistake in the book several times over and eventually honed a way to make money with minimal effort required. And that's the sweet spot of trading the weekly and the daily time frame.
Fantastic. Well, let's just get right along and let's have a look at this set and forget strategy that you've been using.
Fantastic. Well, thank you very much, Simon, for inviting me onto Round the Clock Trader. It's always a pleasure taking part, and they're always great events, which I thoroughly enjoy taking part in. Um, so, as I'm sure you're aware, this webinar is going to be focusing on set and forget trading, and I really just wanted to bring your attention to one very straightforward, easy strategy which you can really take home with you today and use. I know Zahir focused on trend trading and trading the breakouts. And I'm also going to focus on trend trading, and I'm going to focus on the pullback. I acknowledge the merits of trading both, but as Zahir's already covered breakouts up, and I'll cover trading the pullback. Okay, so without further ado, just have a look at the disclaimer, please. There's nothing untowards there. Don't worry, I'm not going to sell your information to the Russians. For those of you who don't know me, my name is Rob Colville. I founded The Lazy Trader about 6 years ago. I used to be a journalist. I moved to London because, frankly, in Cornwall, where I'm from originally, unless you're into milking cows, picking flowers, or talking to God, there's not really much in the way of opportunity down there for your ambitious 20-something-year-old graduates. So moved to London and realised that being a journalist wasn't really going to keep me in the manner to which I wanted to become accustomed. So I fell into financial markets trading and made every single mistake in the book. Many times over, I was very arrogant, having got a first in my degree, and extremely greedy with my kind of insatiable lust to make money and get ahead. So yeah, I really did not do a very good job in trading, and reluctantly, I moved up to the daily and the weekly timeframes, and then essentially decided, and out of my own training, I just found a mentor, and he taught me a couple of strategies which I've since developed, and I realized that, okay, trading, for it to work for me, has to become a boring activity where I can just simply set my orders up after some concentration, walk away, and allow my money to work for me on autopilot. And I think that's a sweet spot for a lot of people. A lot of people get hoodwinked into poring over the charts day in, day out, because they're so used to swapping time for money with their careers or their jobs or their professions, whereas actually there is a disproportionate return of time and money in trading. And just because you trade the weekly or the daily time frame, it does not mean that you'll make any less money than someone who trades intraday. In fact, that's a complete myth and a complete fallacy. And I really think that that myth is perpetuated by these kind of get-rich-quick schemes online. Anyway, that's a little bit about me. I'm pretty sure you didn't take time out of your busy Wednesday to hear me prattling on about myself all day. So let's get straight into the strategy here, which we've developed. I mean, it's for the benefits I've just mentioned. By the way, just as a side note, I am going to be giving away gifts throughout this webinar, so please stay tuned and drop us an email if you did want to take any of these gifts: one-to-one mentoring, ebooks, video courses, and access to our 7th of January event. It's on a first-come, first-served basis. Anyway, let's go back to the strategy, because this is exactly what this webinar is about. So this, unsurprisingly, it will work pretty well on the daily and the weekly timeframes. Why do we choose the daily and the weekly timeframes? Well, they give us a better kind of snapshot of the market. The levels are better established, so are the trends. There's less chaos and confusion. Basically, it's the time frame where the bigger dogs trade, and you can take advantage of bigger moves. You can hop onto a pullback, for example, an upward trend. You buy the dip, or a downward trend, you sell the rally, and you can simply add to the position, as Zahir calls it, compounding, which is exactly the same thing as adding to a position. If you're riding a wave, you might as well stay on it. So if you bought the second pullback or the first pullback, then why not buy the second or third or fourth pullback in an upward trend, and vice versa, selling the rally in a downward trend. Okay, so there are pros and cons to this strategy. Of course, no strategy is perfect, but certainly it's good if you want to take advantage of a style of trading which allows you a higher probability. Remember, the trend is your friend until the end when it bends, because you're trading in the direction of the big dogs, the smart money, the more influential players in the market, whatever you like to call them. Essentially, the odds are on your side, far more so with a trend, rather than trying to pick reversals with your small trading account, quite frankly. Okay, so we can get into big moves once they're confirmed. We can essentially ride the wave, piggyback the underlying sentiments. The rules for entry, management are quite clearly defined as well, so there's little scope for you to go wrong. This does epitomize set and forget if you're trading the weekly and the daily time frame to the highest degree. We don't really need indicators, and this strategy is universal, which is the great thing about it. I mean, for me, I'm not seeing much in currencies at the moment in terms of opportunities, so gravitating towards stocks, you can trade this on stocks or commodities. You can do it on any time frame as well. You can do it on the 4-hourly or the hourly, but I do recommend the daily and the weekly for the lifestyle benefits it gets you. Okay. So the cons, there are always a downside to every strategy. Well, markets only trend 20% of the time, roughly speaking, and of course the fewer rules for entry might create a fear-based disposition. Okay, so let's sum this up in a nutshell. We want to buy a dip in an upward trend and sell the rally in a downward trend. That is essentially all you need to know of trend trading 101 as a principle. But how do we do this? It all sounds very simple in reality, but how do we actually do that? As you can see here visually, I'm going to go to the charts after I've given you the theory. I'm a great fan of actually showing you real-life examples rather than giving you perfectly drawn PowerPoint presentations, because, quite frankly, you do need to become accustomed to the market. Markets are an ever-evolving phenomenon, or animal, whatever you like to call it, species, shall I say. Markets change over time, and there is no such thing as a perfect trade. So when you can kind of essentially sync yourself to the market and understand how to read price, the more screen time you have, the better you will be, the more intuitive it becomes, okay? But when you've got a set of rules, like we're going to go through very shortly, it will make this process far easier. So, in essence, in a nutshell, is buy the dip on an upward trend and sell the rally in a downward trend, okay? So how the heck do we do this? Well, we use moving averages, and I know Zahir uses the 200 SMA and I believe the 50 as well. I use EMAs, which are exponential moving averages, and I use the 200, 50, and the 20. And to qualify an upward trend, the more objective we want our trading to be, the better, or make it be the better. So we want the 20 to be above the 50 to be above the 200. And what I would like is the angle, order, and separation. Okay, I want the 20 to be above the 50 and the 50 to be above the 200. I want space between all three, and I want them to be angled upwards if we're anticipating by a dip in an upward trend. Okay, on the flip side, in a downward trend, we're also, we're looking for the same order except the other way around. We want the 200 to be above the 50 to be above the 20. Okay, because this, for me, is reflective of time frame correlation, where we've got an agreement between the medium, long, and short-term traders out there. That is what's important for me, okay? When we are on the same page as all the influential people in the market, or most of the influential people in the market, those who've got the power to actually make the move collectively. Okay, so just very quickly, upward trend, all right, you've already had me talk about the order, angle, and separation of moving averages. We're typically, in our ideal world, we want higher peaks and higher troughs. Okay, so we're waiting for this to happen. High highs and high lows, you might have heard it as. Okay, we're just simply waiting for a pullback. In a downward trend, we're waiting for lower peaks and lower troughs. Okay, nothing ever goes up or goes down in a straight line, and that's the beauty of it. So think of it as the market breathing out to make the extension, to make a higher high, and then it breathes in before breathing out, before breathing in and breathing out. And what we're waiting for is the pullback and a signal bar, i.e. our entry, which is a very specific price action based bar, which I'm going to talk to you about in just a second. Okay, so let's talk about how we look for selling opportunities in a downward trend first. I'm a big fan of bear markets because they tend to move faster than bull markets. The old expression, the bear falls out the window whilst the bull climbs the stairs, really kind of like can be applied to that. So let's talk about selection, timing, and management. These are the three components really I like to have when it comes to deploying a strategy and applying it to price in the markets. Okay, so like we have here, we've got, like I just mentioned, what do we want for a downward trend to qualify it as a downward trend? We want the 20 to be below 50 and the 50 to be below the 200. So we've got the extension, the pullback, the extension, the pullback, lower highs and lower lows. So what we want is to sell the rally. We want to sell the pullback. So what we want is at least 3 consecutive buyer bars in a downward trending market, because that will give us a better price point in which to sell and ride this wave, which has already been created for us. Okay, so we've got 3 consecutive buyer bars, preferably with higher highs and higher lows. Okay, so that is what we want. Okay, so what about our signal bar? Well, our signal bar is specifically a bearish pin bar reversal, which is styled as a open and close with a tail. Okay, you've probably seen these around the market. They're a very good signal for us, reflective of in the day or the week, depending on what time frame we're looking at. We are seeing price coming up and being rejected by the bears, which have forced price to close in the same portion of the bar, i.e. the bottom third is where it opened. This is a good sign to us that price is going to fall the next day or the next week if we're looking at the weekly chart. Okay, so just to recap, we want the order angular separation of the 3 moving averages. We want a pullback of at least 3 consecutive buy bars, and then we want our entry, our signal bar, which is the bearish pin bar reversal. Okay, so then what? How do we trade this? Well, what we do is we place our order just below the bar here, stop loss above the high, and then we set our orders up and walk away. If we're trading, say for example, in London or European time, European session, then we want to place our trades up. If we're trading the daily at 10 p.m. GMT, if we're trading on the weekly time frame, then we trade them last thing on Friday night or over the weekend if you're trading with a Bieber broker, or indeed first thing on a Monday morning or last thing on Sunday night when the market's open again, if we're trading currencies, that is. Okay, so we talked about sorry, yes?
Daily bars or weekly bars? What are we looking at here?
Oh, these can be either.
Okay.
That's the beauty of it. I mean, I'm talking about this as if it could be the daily or the weekly time frame. That's the benefit of it. Okay, so if we're trading the daily, just to clarify, we need to do this at the end of the day, coinciding with the New York close after about 9-10 p.m. GMT. And if we're trading the weekly time frame, then Friday night last thing or Sunday night last thing, in order to coincide with the close of the market or the open of the market.
Okay, and what about volume? Does that play a part?
Well, at these times, volume is dropping off essentially. So, say for example, we're trading on the weekly time frame, and Friday afternoon, Friday night, typically the volume is very low, and we can anticipate setting up our orders and then not being triggered in some kind of wild card mood. Typically, that will coincide with the close of the bar, and we'll only be triggered into the trade if there is a decisive move in our direction.
Got it, thanks. That's great.
No worries. So let's move on to how we can manage this trade, because it's one thing to find the opportunity and the setup, and a lot of people pay too much attention to actually finding the opportunity and the setup. And as soon as they're in the market, they've had the excitement of potentially making money, and this trade looks like it could make this much. But what do you do when you're actually in the trade? A lot of people kind of only realize this when it's too late and they're in the trade and they're offside and they think, damn, what do I do now? Well, hopefully you've only risked 1% or 2% maximum of your trading account on the trade. I always say risk 1% if you're consistent and 2% plus if you are consistently profitable. How can you measure that you're consistently profitable? Well, I usually say if your equity curve is positive after 6 months, then you can afford to risk a little bit more incrementally than 1%. So how do we manage this when we're triggered into the trade? Well, what we do is we have a 2-bar trading technique. There are 2 ways you can trade it. You can either just simply wait to be triggered into the market and take half the profits off the table at target 1, and I'll talk to you about that in just a second. Or what you can do, if you want a higher probability outcome but are content with a lower probability, is trail for every second seller bar if we're going short. And what that does is that sequentially locks in profit as well as reduces your risk, as well as gives the market enough room to breathe once you're in the trade. Because a lot of the time, and I'm sure many of you have noticed this, who've kind of cut their teeth on the market, or trading for that matter, they've noticed that as soon as you're in the trade, you have to wait. Say if you're going short, you're in the money, and then suddenly you're giving back a little bit, then suddenly you're in the money a little bit more. Nothing ever goes down in a straight line, okay? So if you're aggressively trending your stop loss, like a lot of people do, then they're stopped out prematurely, only to their horror to see that the market goes down in their favor even more. So there's a bit of a trade-off. I mean, with locking in profit and, of course, giving the market enough room to potentially move against you before you can lock in even more. And the 2-bar trail is an objective way of doing this. Okay, it might not give too much wiggle room compared to the ratchet stop loss or the other all or nothing style, which I'm going to teach you when we go to the charts, but it is proven and it does essentially address 2 problems in one. Okay, so let's take a look at this one. This is Euro New Zealand. This was some time ago. I mean, I'll show you some more current examples shortly. Funnily enough, on Euro New Zealand as well. I actually do quite like that currency pair. So we saw the order, an angle separation of these moving averages. We had what we call a it's a doji bar here, pretty much. We had our entry just below it, stop loss above the high. It was a pullback in a prevailing downward trend, as you can see here. And we got triggered. We trailed over every second sell bar, and we essentially got stopped out, making 5.1%, risking 1% of our capital. Okay, that was a very good outcome. Of course, there is a different way of managing your trade, and that's simply taking half your profits at the previous low here and just letting the other half run. Okay, because like Zahir said, and like I'll testify as well, like if you're riding a trend or a wave, you might as well stay on the trend, because it does take a long time for a currency or instrument to get into a trend and to turn around as well. And generally, you'll notice if the trend's kind of turning around, because you'll see a ranging or consolidation over a protracted period of time, and then the moving averages cross over. And that is my tell for when the trend is bending. Okay, so until we get to that point, you're good to continue in the direction of the prevailing trend. Okay, so let's talk about buy opportunities in an upward trend. Well, it's exactly the same way as what we've just discussed. Okay, we want selection, timing, and management, and what we're waiting for, of course, is what we want is the 20 above the 50, the 50 above the 200, and we want at least 3 consecutive seller bars. Okay, preferably with lower highs and lower lows, before we can reasonably have a look or pay attention to essentially buying the dip in a prevailing upward trend and getting a better price than if we were just simply going long on the extension, which a lot of amateurs do. Okay, so this is what we're looking at for this profile. And after we've had our pullback in an upward trend, we just simply want our signal bar or our entry bar, which is a bullish pin bar reversal. It's the opposite or the reverse of what we required in a downward trend. Okay, you might know these as low test bars or morning stars, whatever you call it. It's the same principle. We've got the open and close in the top third, and we've got the spike, or the tail as we call it, just below it, which is a sign to us that the bears forced price down, but actually the bulls came charging back in and caused this to essentially close in the top third. And that is a very bullish sign for us, especially after a pullback in a upward trending market. Okay, so we want at least 3 preceding seller bars with lower highs and lower lows, and it could be 4, it could be 5, it could be more than that. It could be a complex retracement, which is something a little bit more advanced than this. But as long as you get a bullish pin bar reversal after a retracement in an uptrend, then that's our They are rules for entry. So how do we trade this thereafter? Well, let's have a look. What we do is we simply place our order above to buy the high of the bullish pin bar reversal, stop loss below the low. We should only risk 1% or 2% if we're profitable, and set our orders up and walk away. And then what we do, unless you want to just to leave your trade and take profit the first option and scale out, take profit 1, which we'll talk about later, you can trail below the low of every second buyer bar, because once again, this locks in profit and it preserves our capital. It reduces risk in a very systematic kind of way. And like I said, you don't want to be too aggressive in trading your stop loss because you'll be stopped out early. You don't want that, especially if price surges in your direction. But you also want to lock it in, and you also want to reduce the risk. Okay, so that concludes our strategy. So this was a trade we took on the daily, I believe, last year. We've got certainly more recent examples, don't worry. This was on the eve of the general election when the Tories were neck and neck with New Labour, or Labour as they now call it, with Miliband. And we saw this setup bar. We had the entry just above the high, stop loss below the low. I know we have a sideways movement with the moving averages, but the fact of the matter is we're trending upwards very nicely, actually, looking at the daily here, making lower highs and lower lows. And this is a false breakout of a triangle. And when you've got the open and close just on the line or above it, and we're prevailing upward trend, then we can reasonably expect price to surge upwards. If it breaks this complex retracement here, then we know that price is very likely to be out of the woods, and we can see price going up to the previous swing high, which is great reward to risk. And of course, the Tories won, and the markets like that quite a bit. And this is where we get the trade-off between different styles of managing the trade, because if you were to do the 2-bar trading technique, sure enough, you would have entered above the high, stop loss below the low of the signal bar, and you would have tried it below the low of every second buyer bar. But of course, you'd stopped out slightly prematurely here using this style. What a lot of people do, what a lot of our clients do, is simply they move their stop loss to break even after they've made in profit the equivalent number of pips that they've risked, and they just wait for price to get to their first target, which is the previous swing high on upward trend, or the previous swing down the downward trend, and they scale out, they take half their profits off the table, and they just leave the remaining portion of the trade to do its thing. Okay, so that's the important thing. If you're riding a wave, you might as well continue.
Rob, a couple of questions, if we may.
Sure, no problem.
Is this method of identifying trends based on daily candles only?
Yes. I mean, to be honest with you, I mean, if it's trending on the daily, it's very likely to be trending on the weekly as well. I mean, what I tend to do is I start off, in my analysis, I start off on the monthly, then I chunk down to the weekly, then I chunk down to the daily.
Okay. How do you know?
Sorry, carry on. Sorry.
How do you know it's a valid pullback? Asks Ray.
Okay, it's a valid pullback. I'm just simply waiting for, like, in an upward trend, higher swing highs and higher swing lows, and I'm waiting for a pullback with at least 3 seller bars. Preferably the moving averages are in the right kind of order, and that's what I'm waiting for a pullback. I mean, I will show you some examples of this, because it's only fair that I give you, examples on the charts rather than just these hindsight examples. I mean, we've got a few on the watch list as well, and I'll show you some of my more recent trades. So it's only fair we kind of put this in the perspective of the current market.
Okay. One final thing, John says, you say risk 1 or 2% and also place the stop loss just below or above the setup bar. What do you do if the risk on this bar is more than 1 to 2% risk?
Well, you should risk more than 1% on any bar, any setup, no matter how good it looks. You can do you need to trade size, which is essentially dividing 1% of your trading account by the number of pips difference between your entry and your stop loss. That is the formula which will allow you to trade size. If your broker doesn't allow you to trade with small stakes, then find a broker who does. But it's very important that we risk no more than 1%. You want to essentially have your strategy producing risk-adjusted returns in as much of a scientific way as possible. If you're risking at 4% here, 8% there, then you'll have no real measure of how good your strategy is and how good your performance is in real time.
Okay, got it. And do you add to positions as well?
Absolutely, yes. I mean, like Zahir, I mean, if you're trading with the trend, it would seem like an awful waste if you're saying, for example, you're buying a pullback in an upward trend, and you've taken profit, you've immediately exited the trend at your first target. That to me is a tremendous waste. It's like a surfer who's just gone down to Fistral Beach in summer, and they just jumped on this wave to hang 10, and they've just had like 5 seconds of bliss, and they've just jumped off because they feel like they're the rest.
I like the analogy.
Yeah, well, it's true. I used to surf, and I still do when I blow off the cobwebs. It is very true. It's a form of self-sabotage, and it's true of a lot of retail traders who are new to the market. They'll happily take the full hit, but as soon as they see that flash in the pan, that glimmer of profit, they'll quickly exit the trade, only to their horror to see that position run completely in their favor plus more. And that's a real self-sabotaging way of going.
Yeah, it's a theme of advice that I hear coming out all the time on this event from various speakers. It seems to be the one, that one issue alone is what I think prevents a lot of people from getting the returns that they're looking for. So it's sort of it's going against your natural instincts, of course. So it's something that you have to train yourself. I know we've got Dr. Kenneth Reed coming on at 12 o'clock. He's a psychologist, trading psychology coach. So he'll be looking at some ways to combat that. But in the meantime, let's get back to your presentation. I'll let you carry on. Thank you very much.
No worries. Well, I just wanted to, and then all great questions, and please do keep them coming. I'm just going to just talk to you a little bit more about moving averages and talk to you about steepness of them. An analogy I like to use is the clock face. So you had me talk about order and separation between the moving averages, but one thing I want to talk to you about is angle. The steeper the angle, the better it is. And what I would say, to qualify a good upward trend with good speed and momentum behind it, are if the moving averages are facing to the equivalent of between midday and 2 p.m. And that, generally as a trader, we want our outcome to be served to us as quickly as possible, as reasonably possible by the market. We're not interested in really just any laggards. So we can identify a fast-moving market where in an upward trend, say the 20 is above the 50, the 50 is above the 200, and they're nicely faced towards or in between 12 to 2 p.m. That's going to give us more faith in the trend. And you can see that here, order angular separation, the 20 above the 50, the 50 above the 200. Conversely, it's the same in a downward trend, where we would want the moving averages in a fast-moving downward trend with good speed and momentum. We'd want that clock face to essentially represent or be represented by the moving averages going between 4 and 6, because that will reflect the voraciousness of the downward trend, compared to if it was facing between 3 and 4, where, okay, the downward trend is still in play, but it might not be as fast or as voracious as if it's between 4 and 6. So there we go. Order angular separation. The three components I look at for my three moving averages, the 20, the 50, and the 200. Separation is good. It's another clue reflecting the market speed and momentum. The angle shows the market speed, and the order, of course, if they're the right order, it shows that the short, medium, and longer term traders are on the same page, essentially, and that's what we want. Okay, so let's kind of talk to you about a couple of examples. I'm going to go back to eSignal, which is one of my charting packages. I love eSignal, and I've always been of eSignal. I've got a real soft spot for them, and I like to keep things very simple. So I just want to talk to you about Brexit and how I traded that very quickly. I mean, we traded the reversal of pound Swiss this time last year, actually, which was a reversal strategy, which is something I'm not going to go through today because we're talking about trending at the moment. But I just took this lower high here, this bearish pin bar reversal representing the lower high at a level that hasn't been broken in over 7 years or so. You can see this is quite a ceiling on price. Let me just demonstrate that to you even more with this here. There we go. It hasn't been breached since 2011. Okay, 5 years, my apologies. So here we go, place my entry just below the low, stop loss above the high, and then we got triggered into the trade. I almost missed this one because I was driving down to call, and I was pretty glad I didn't. But with such a big move, remember that pound versus the Swiss franc is sandwiched between these two price points and has been for the past 5 years. So you can get trends inside ranges. And we were just waiting for, certainly for trending opportunities, we wanted to add to this position, and we were looking for a trend-based play once we had the crossover of the moving averages, once we had time frame correlation, the 20 crossing below the 200 and the 50 moving also through the 200. So we had the extensions. Remember, we're still in this tiny little trade here. We're up about, risking 2%, we're up about 20%, but we're waiting for an opportunity now, as we've had the crossover, the dead cross. We're looking for an opportunity to sell the rally in a downward trend, and we had one here. Let me just go back. An opportunity right here. There we go. We had a pullback. We had what we call a bearish pin bar reversal. Place our entry just below the low here. Stop loss above the high. And the first target for our second entry was the previous swing low. Okay, and we were, if as and when price got to this previous swing low, what we would do, we wouldn't trail up every second seller bar because this was taking advantage of such a big move. We wanted just to really max out on it. And as the kind of like the pantomime between Farage and David Cameron, leave versus remain, got more and more vociferous, that of course influenced price. One camp was ahead, the leave camp was ahead of the remain camp, and vice versa. But this always influenced price. And so we traded this one again, or triggered into the trade, and then we took half the profits off the table at this point here. We remained in the trade, leaving half of this one on, because we were looking at the bigger picture here, price potentially coming all the way down to 1.2600. We haven't quite had an opportunity yet to buy the rally, but it's coming. There we go. We had one right here. And that's exactly what we took. This is what we wanted. This is what was a great textbook example. So we placed our entry just below the low here, stop loss above the high. Please note the position of the moving averages, the 20 below the 50 below the 200. And our first target was the previous swing low. We didn't trade up at every second seller bar, but I know some of our clients did. It depends. I'm quite happy. I'm quite content with an all or nothing outcome. The first thing I would have done is move this stop loss to break even, and I'd have left it just to have trailed to the first target, the previous swing low. And let's see how this did. This was our trade of the year, and we were in this trade for about 6 months. We had another opportunity right here. Let's just jump back to this one. I traded this one. We traded this one as the lower high after a retracement. So we placed another entry, moved this. We reduced our risk on this one. We moved our stop loss to the halfway point of this first entry, but placed another entry just below the low, stop loss above the high, first target, this previous swing low. There we had it. Came down, all the way down to the first target after a bit of faffing around. Okay, and that's essentially how we played pound Swiss in that time. We were looking to sell rallies. You can see here that, okay, on the monthly or the weekly, you'd think that pound Swiss is just sandwiched or just range bound. Actually, the range is so big, and this is the case for a lot of cross-currency pairs. The range is so big that you can identify and take advantage of trends within inside these ranges. And okay, now let's take a look at pound Swiss. A lot of the dust has settled. It's a bit confused. Well, we've had this pullback at the moment, and price, it's a very reluctant pullback. We've had for the first time in quite some time, ever since the actual decision of Brexit, we've had the 20 moving up above the 50, but I'm still on the weekly. I'm waiting for an entry for a sell. Okay, so we've still got the fanning here. And it's the same for a lot of these currencies. A lot of the pound crosses, I'm just waiting to sell the pullback on the weekly time frame. After such a big move, generally you are going to get a pullback or hesitational price, just what I call faffing around. And I'm just waiting for a signal bar, i.e. a bearish pin bar reversal on the weekly, preferably with a naked tip. So that's what is going on in pound Swiss. Now let's show you a more recent example. This is Euro New Zealand on the weekly time frame. Let's just go there first. There we go. This was, we didn't have much space with this one, okay? Because you could say, okay, And I understand if you are thinking this, okay, this just looks range bound. Okay, downward trend up all the way till about 3 years ago. But the fact of the matter is if you look at the kind of fundamentals of the Eurozone, in Europe, the interest rates are 0%, in New Zealand, they're 2%. So you can reasonably expect the bias, fundamental bias to be down. And of course, the Eurozone is, well, it's got to be applied here in terms of like diplomatic. But, we look at Brexit, you look at Italy, and potentially them leaving the EU and a referendum in France looming if Le Pen gets in, then that's really going to give a few knocks to the Eurozone. And this was, okay, I don't trade news based on what news is being said at the time, but certainly I have an eye and an ear for the general sentiments. And certainly if I was to trade this bearish pin bar reversal after we got the 20 below the 50, the 50 below the 200, I thought, well, at least, okay, a 1-to-1, an easy 1-to-1 would be good here, just to potentially take half the profits at this point here, the previous swing low, and align ourselves for breakout if it does happen, if price does come down and smash through this level, and see what happens. Well, price did actually come down and test the level. So we took half our profits here. At this point, we left half running, and we moved stop loss to break even. There we go. We got pinged out. Exasperatingly enough, we got pinged out at a no loss gain. So we made half, about 1% on that. But what we're waiting for now with Euro New Zealand, given the fundamental polarized picture between Europe and New Zealand, I'm just simply waiting for the extension and then a pullback, price to kiss this level, 1.5106, before a potential continuation to the downside. So that's what's on the watch list. Apart from all the pound crosses, I'm just waiting to sell the rally and a projected long-term retracement. Gold, silver, last year, great sell opportunity on the weekly time frame, I believe it was. Here we go. So I was in Malaysia at that point, and we just saw this in the morning. We just grabbed it for a nice, easy, quick gain. This was, again, on the weekly. We saw, as you can see here, the alignment of the moving averages. We had the 20 below the 50, the 50 below the 200. The 50, curiously enough, was behaving as a dynamic level of resistance. And you can see that it's tested once, twice, thrice. And moving averages do this. And this is what I love about the 50 moving average when I'm looking at stocks, because unlike horizontal levels of support or resistance or trend lines, for example, you can get the moving averages acting as that. And they're actually more objective than trend lines or horizontal levels because they're already on the charts for us based on a mathematical formula. And there's less chance of us mere mortals, us humans, to bodge it up with our own emotions being poured into it as well. Okay, so as per strategy rules, we had the retracement here, order angle and separation of the moving averages. We had the big bearish pin bar reversal here. It's an outside bar as well, which is a good extra clue based on wider understanding of the market. It's not an engulfing bar, it's an outside bar. A lot of people get this wrong. An engulfing bar is when the open and close takes out the open and close of the previous bar. This bar's high and low takes out the high and low of the previous two bars instead, so it's an outside bar. So we placed our entry below the low, stop loss above the high, first target the previous swing low, just above it here, and that was a decent 2-to-1-ish, risking 2%, potential easy 4% gain. So we got triggered into the trade, and nicely just took some profit, and we left half to run, of course, because like I said to you before, okay, it might have hit take profit one here. That's all very well and good, but gold and silver could have gone down even more after that. And my apologies, this was silver. But gold and silver are pretty much the same thing. They follow each other very kind of like quite closely. So even if you did the two-bar trading technique, you will still have been taken out of the market at a decent profit. Okay, so the two options depend on what kind of trader you are, really. The two-bar trading technique is very good if you're relatively new to the market and you want a high probability, lower reward outcome by being careful, pragmatic, and judicious. The all-or-nothing outcome, which is what I do, is someone who just is quite happy to lie and wait for the occasional big game, but is also happy with a few break-evens until that point. Okay, so that's gold. Sorry, silver. My apologies.
Rob, can I jump in just with a few questions which are queuing up?
Absolutely. Yeah, please do.
Yeah. The moving averages weren't in line with the first trade, says Jay. Can you explain that? We're going back 5 minutes. So,
£2 Swiss.
Yeah, I think it might be the previous chart.
Okay, no problem. Well, let's take a closer look at that. Let's go back. This is in the daily time frame, wasn't it? Oh no, okay, of course. And this, I think you're talking to when we were talking about this point here, when we were trading the reversal. And you're absolutely right. This is not a trend-based play. This is a reversal trade. So I just wanted to show you this one to really kind of like show you a little bit extra in terms of how we took advantage of a big kind of macro move here. For trend-based trading, we would not advocate trading this one as a trend-based play at all. Certainly do not go long into big levels. And even if you did just trade trends, you'll be doing very well as a trader trading that one strategy. So what we just discussed was not a trend-based play. What we did discuss, which were trend-based plays, just to clarify, were these examples coming up. Let me just go through it again. This one here. Okay, so let's go back. This one, let me zoom in for you. That was our first trend-based play because we had the 20 below the 50 below the 200. But more significantly, our second trend-based play, and this is where we really had the kind of perfect storm with moving averages. We had a lot of space for the market to move. This one here, bearish pin bar reversal. This is our second trend-based opportunity to sell. First target here. And then we had our third right here. There we go. But a lot of people were just content trading this one here, and that was that, and just hanging on to it. Okay, so that's a good question, and thank you for bringing that to my attention.
Okay. Anton says, can you use this strategy on a lower time frame?
You can, but I wouldn't recommend it. I mean, I think for me, on lower time frames, I mean, how low do you want to go? I'd say the 4 hourly are fine, but on the hourly and below, price just gets a little bit noisy and a little bit susceptible to news announcements, data releases, and because you've got a much smaller distance between your entry and your stop loss, that could really influence, that could really tempt a fate with being pinned out. I don't like trading anything below the daily. I take a look at what the hourly is saying. Say if I'm trading, say for example, I set up on the daily or the weekly, and I get a nice reversal pattern that supports my bias on the daily or the weekly on the hourly time frame, then that makes me happy. But I never, ever, ever trade off the hourly time frame or below.
Okay. And oscillators and settings. What settings and oscillators are you using?
Okay, I wouldn't for this. I don't really look at RSI or stochastic. But for those of you who do want a good setting for the RSI, setting 6 is one of my favorites because it reflects a shorter term. If you have an oscillator that is too long term, then it's almost irrelevant, really. Like, for example, this one here. Let me just go up. And it's added confirmation. So I believe when we took this setup a few months ago, let's just jump back there a minute. There we go. So on RSI setting 6, what gave me an added confirmation for this was the fact that the RSI setting 6 gave me what I call bearish reversal divergence. So price is making a higher high here, but the RSI is making a lower high here. That's a sign to us that the strength in the buyers is getting more diminished in terms of this pullback. What was also significant for me as well, looking at this one, just on a side note, was the fact that, okay, if you think about it logically, okay, if we have our entry below the low of this bearish pin bar reversal and our stop loss above the high, then price would, in order to get into the trade, it would have to take out this bar's low. Now, if we look at the preceding bars, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, only one out of the past 10 preceding bars lows has been breached. So if it is breached after our setup bar, that would be significant. That would be a significant event in its own right. Yeah, but that's just a little bit of extra refining criteria for you. Okay, so Brexit was a very lucrative time for us, as you can probably imagine, and we all seem to historically do quite well on, like the Scottish referendum, we did quite well, and the general election, of course, with the Tories versus Labour last year, roughly the same time as Brexit this year. So we'll see what happens next year. Maybe we'll have it. Okay, good stuff.
Okay, we've got about 10 minutes left, if I can let you carry on.
Sure, no problem. Well, let's talk about Euro GBP just very quickly. I mean, we traded this one as well, just to really kind of like give you one more example of like markets which responded well to this one. And we had this here. Okay, protracted downward trend. Let's just wait for the moving averages to align. There we go. So protracted downward trend, and we had, for all intents and purposes back then, lower highs and lower lows. We had this pullback here. We had this horizontal level. And we had this signal bar to potentially go short. Entry below the low, stop loss above the high, first target the previous swing low here, and that's when we would look to take half our profits off the table and keep half the trade running after the breakout, if we get the breakout, if we got the breakout. Okay, so traded nicely into this trade and hit profit quite quickly. There you go, and it's all very nice. All very nice. Now I'm going to show an example very quickly of a losing trade, because I don't want to just show you winning trades. It's not real. I mean, we get losing trades in trading as well, and there's part and parcel of it. You know, every losing trade is a business expense closer to a string of wins. So this was a pound Aussie, and this was on the weekly. I took this when I was in Cambodia, and I kind of wish I hadn't, but it fulfilled all my rules for entries, so of course I was going to take it. So we had just about, okay, just about, I know what you're going to say, the 50 is not below the 200. Whatever, it's fine. It is kind of just there anyway. So we traded this doji bar just after retracement in this downward trending market now, qualified by the fact that the 20 below the 50 and the 200 and the 200 just inching above the 50. So we placed our entry just below the low, stop loss above the high, first target the previous swing low, and we got into the position, and then we got nailed out of the position. We lost 2% of our trading account then, but overall it's been a very successful year trading, and you know, losing trades are part and parcel of it. And after a long string of wins, I was anticipating a drawdown, and that's one thing which, you know, after every successful trader who's had a long patch of wins, they're always going to anticipate the drawdown, and this might cause recency bias, and that's natural because you don't want to lose sight of the euphoria. Okay, so that is essentially everything I've got covered for the webinar. I just want to bring your attention to this. It is Christmas time after all, and the season of giving, and we also want to celebrate our record-breaking 700th client. So what we want to do in conjunction with London Investment Week Round the Clock Trader is give you something special today, and that is access to our online trading course, our flagship training, the Ultimate Program, which is dedicated to helping you become a first-class trader trading any asset class in any market from as little as 10 minutes a day. You can become a master on the weekly and the daily time frame through just this program, and we're going to give it to you valued at $1,997 US. We're going to give you 1 month test drive for $30, and in that you're going to get everything you could possibly want. You're going to get trade ideas, weekly market analysis, videos of all of our tutorials and strategies, both basic and advanced. We've got some pretty new things like the Trader Hypnosis audio course, which is brand spanking new. We've also got our own proprietary pattern recognition software and trader psychology. We've got a forum for you to network with people around the world who are trading your style of trading, like lazy trading. We've got very supportive mentors in our community as well. Okay, so if you want to take advantage of it, it's 88% discount for today only. It ends at midnight tonight. Please just go to our website, thelazytrader.com/forex training, read the terms and conditions, buy the Ultimate Program, use the promo code round the clock, and you know, if you're not 100% happy, you can always get a refund. We've yet to have someone who's done this, but there's always a first. But that's the deal, and we hope to see you on board. And it's one of the best deals we've ever had, so we look forward to working with you. If you've got any questions on the webinar we've just delivered, please do ask me, and I'll happily answer them for you.
Thanks, Rob. Yes, a few questions we didn't get to earlier on. How many lots do you normally trade on average? What would be your typical lot size?
Okay, well, it really does depend on my risk, okay? On the daily and the weekly time frame, I'm going to have quite a big difference between my entry and my stop loss. So I typically just look at it as 1 or 2% of my trading account, okay? that's as simple as that. I have a spread betting account as well for tax purposes in the UK. So I'm very lucky. I do things as a stake size instead of lots.
Hmm. And yes, how many trades on average then do you take?
Well, and that's another good question. It's quite a common question, and it's one which I always like answering because with this style of trading and time, the return number of trades taken is thoroughly disproportionate. So what I would say is actually you can expect anything from 2 trades to 8 trades a month. It does depend. I mean, it depends how active you are. Remember that these strategies which we teach are universal. They can be applied on currencies, stocks, and commodities. And if you think about it, you've got 350 UK stocks in the FTSE 350. We've got the S&P 500. We've got the Dow 30. We've got the Russell Index in America. There's thousands of stocks you can apply this to. Thousands. So as our kind of like core instrument are currencies, we, in terms of currencies and precious metals, we trade between 2 and 8 times a month. But you can always trade more, and you can always look further afield to stocks and apply this successfully.
Gotcha. Okay. Do you use weekly, monthly, and yearly pivots in your trading?
I actually don't. I used to, as an extra tick in the box, but I actually, about 5 years ago, just decided just to keep it very straightforward and remove everything apart from price, obviously, and moving averages and the RSI setting 6, because the simple, actually having less in your charts has really helped me over the years. I remember when I first started trading back in 2007, I had everything going on, absolutely everything. My chart looked like a Picasso painting, and it didn't really serve me any favors whatsoever. So as you can see, hopefully you've seen it for yourself, that my chart only consists of price, a few levels, not very many at all, moving averages, and that has given me the clarity. I'm very blinkered as to what I look out for when. Very blinkered indeed, but that's served me well. Okay, it's fine to have a very orderly strategy with tight rules for entry or well-defined rules for entry and management in a market of chaos and confusion, because markets are, anything can happen at any time in a market, and it is chaos. And if you've got a well-defined edge, then that's your constant. That's your measurable tool in the market. I hope that answers the question.
Yeah,
I went on a tangent there.
a world of chaos and confusion. Yeah, you're right. Rob says, how many pips below or above the entry bar do you program for entry?
Okay, good. Another good question. I mean, if you want to look at it in a very kind of like fastidious way, I mean, I would say a few. It depends. I mean, what I tend to do is have, for example, if I'm going long, I'll just take the entry of the bar as the long entry of the bar would be the ask price, the high, not the midterm price quoted by the broker, but it would be the ask price, and the stop loss will be at the bid price. If I'm going short, I'll take the low of the bar. My entry will be at the bid price, and my stop loss will be at the ask price. And that's really how I do it. I mean, what you could do, if you just want to keep it very simple, is just have your entry 5 pips below the low and your stop loss 5 pips above the high if you're going short, or if you're going long, you can have your entry 5 pips above the high of the bar and your stop loss 5 pips below the low. I mean, that's a very simple way of doing it if you're quite new, and the whole bid and ask prices thing it has baffled you slightly. I mean, it took me a while to get used to all this kind of like jargon. Okay.
Yeah, that's right. That's right. What about scanning technology? Do you use any scanners to identify potential trade settings? I know you've been using eSignal for these charts. Anything else that you use?
I'm going to give you a very boring answer to this, I'm afraid. I don't. I actually just scan through manually because it's good trading for me. I recognise the use of scanners, and I know people who've done very well using scanners, but for me, my learning, I just like to go through each chart individually and just pore over it. And every weekend I do this for about 1 or 2 hours, and I just like to assess the chart for its own merits. Okay, and that's it. I think it's good practice for me. Trading, I know I don't trade for very long, like 10 minutes a day, an hour a week, whatever. But I recognize it as being a muscle. I do still need to look at the charts, because if I get lazy, that muscle, it's like learning a second language. If you've learned French, for example, and you haven't spoken French in 10 years, you're going to forget words, you're going to get the grammar mixed up. It's like a muscle you need to train, and this is why I don't use scanners. I've got 26 currency pairs, 2 precious metals, and when I'm bored, if there's nothing going on in the market, I go to the Dow 30. That keeps me out of trouble and off the streets of London.
Okay. Now, Ian says, Rob, do you normally qualify the top of a downtrend pullback as being above the 20 or the 50 moving average?
No, I mean, in terms of a pullback, I mean, sometimes you get them going into the moving averages. Sometimes you get them still below the moving averages. It doesn't matter for me. Okay, it really doesn't at all. I know some people think, okay, goodness, the setup bars are between the 50 and the 200, but in reality, certainly from my experience, it doesn't matter that much. Okay, if the pullback has got to the point where it's above the 200 moving average, then it's definitely the trend has ended. But certainly, if you get the pullback bars in between the 20 and the 50, then don't worry so much at all.
Yeah, Ian's just saying he can't find the promotion on the website. The promotion is applied, I believe, when you insert the promo code around the clock. Is that right, Rob? That would be.
That's absolutely correct. You go to the Forex training page, and when you've got a page there which asks you for your details, your name and email address and everything, you type in into the promo code box around the clock, and you hit the apply button. That's important. You hit the apply button, and that will generate your discount.
Right.
Don't just whatever you do, don't just type in around the clock and just put your credit card details in without hitting the apply button, because it will mean you'll be charged full price, and we don't want that to happen today. It is Christmas, and this is this is a festive gift.
Season of goodwill. I'm putting your email address in the chat box there for everybody as well. If anybody has any problems, perhaps they can just email you directly. GG says, if we buy the course today, when is the latest that we can start?
You can start immediately.
Or is there a time limit on that? I think that's what the question is. Maybe can it be deferred? So to buy now but not start the course, is there any sort of expiry date on the course?
No, don't worry. You're fine. Believe it or not, I'm a very reasonable person. So if you take advantage of the offer today and you don't log in for a couple of weeks, no problem. It's fine. I mean, I've got clients on there. I've got one client, a couple of clients who've been a member for 4 years. They log in once a month, and that's enough for them. They've got people who log in every day and download every podcast and webinar and guest lecture I have under the sun. So it's up to you, but I think it's a reasonable price for training long term. Because we used to charge £2,000 entry fee, and we realised that actually people would prefer the pay and goes approach. It's fairer because people can just cancel when they want. Generally, it's after about 6 months or 6 to 9 months.
Okay, Rob, we're going to have to draw it to a close there. Rob Colville, the Lazy Trader, thank you for joining us again, and thank you for all your support throughout this year. I'm going to take the presenter role back for you for the last time, and hopefully we can hear from you again in the new year. But in the meantime, thanks again.
Thank you, Simon. It's been a pleasure, and I wish you well for the rest of the event.
Thank you.